Hey everybody, welcome to another edition of Midas Letter RAW! And I'm here as per usual with my good friend and co-host, Special Ed Mileski. Ed, how are you?
I'm back. I'm back, yeah.
You're back. You spent quite a lot of time on the East Coast these last few months.
Well, about 4 weeks.
Yeah.
It seemed like longer.
And it was all vacation?
You know, I worked.
Culinary
It was
research?
just, yeah.
What'd you work on?
Seafood.
Seafood?
No, you know.
Did you eat much seafood there?
Yeah, that's all we ate.
Is that right?
Yeah, well, why would you eat anything else? I mean,
Yeah, well, I'm with you there.
that's
the way it is.
you know, they had this one little town on the water. It's got nothing in it except a gift shop and a lobster place.
Perfect. Let's go.
Let's go, yeah.
If you're enjoying the show, subscribe to Midas Letter on YouTube so you stay up to date on everything investment. We got a good show here this week. We got lots of talent, lots of interest. Craig Nicol is going to join us. He's the CEO and founder of Graphene Manufacturing Group. Full disclosure, I am a shareholder in Graphene Manufacturing Group, and from time to time I may buy or sell shares without any further disclosure. So forewarned is forearmed. If I'm talking glowingly about Graphene Manufacturing Group, it's because I'm talking my book. Let's just get that out of the way. They're not a client. I bought the stock, talking my book. Then we're going to have a guest who Ed brought to us, is David Kerbel from a company called Rritual Superfoods. And I don't know if you're following what's going on in the food space, but foods are starting to have a thing, which, how often does that happen?
Yeah, people want to get healthy, don't they?
I guess. And then last but not least, certainly, Wolf Richter is going to join us for a rousing discussion about inflation. Wolf is the founder and publisher of WolfStreet at wolfstreet.com. Real estate is a broken business. Selling or buying a property is slow and cumbersome, prone to errors, and expensive. The entire real estate transaction process is going digital, and there's one company giving investors the opportunity to own part of this future. With Voxtur, transactions can be completed in a few days at a fraction of the cost, all on a single platform. Click now for more information on Voxtur Analytics. Real estate at the speed of light. Now, Edward.
Yes, sir.
I talked to Wolf extensively about inflation because the Fed has been broadcasting this idea that
Temporary.
Transitory. Just passing through. Yet, here's what we're going to do is we're going to look at this chart. Here's the chart we were looking at again last week, the producer price index. Now, I've put this chart to cover the period from January of 2021 to date. And so what we're looking at here right now is a increase of, where are we at? 8% per year? That's just this bar, right?
Yeah, that's from March. From March of this year to now, we're
right.
up. Yeah.
Okay, so let's go to,
beginning of 2020.
There we go, 12.89% is the increase in the producer price index by commodity. So that's interesting. But then we have the consumer price index.
Right.
Which is more representative. That's what everybody's looking at when they're looking at inflation numbers, right?
Well, if you're a consumer, yeah. If you sell, producer, you're a producer, you sell.
Yeah.
You look at the PPI.
Right.
But they're both moving.
Right. Okay, so let's go here. Consumer price index. All right, anyways, let's click on the year to date.
Yeah, let's go to year and date. Yeah.
So we're at 3.83% year to date on the annualized basis, but from June, 2.68. Let's go back here. There's 1 year. That's as far back as we can go. Anyways,
Yeah. Moving up.
moving up.
Yeah. No more stability.
Well, so then if we look at our price of copper, okay, so copper futures have sold off down to 404.
Yeah, that's the lowest. Now, we had a reaction low after the run up to 480 something. In June, down to I'm going to say 411.
Yeah.
Maybe slightly under that. We've breached it, but I will point out, and this may be, may mean nothing, but there is this very big tail here.
Yeah.
And that usually might mean, we're more to the, I like to see, a change in a short-term change direction. Listen, if we don't get back over 410, all bets are off here for copper for a while. It'll get back over 410, but we just don't know when.
Yeah, okay. So, but given the fact that copper is sold off, that there's a general expectation for interest rates to rise as the Fed tries to get a handle on this this inflationary phase.
Yep.
I mean, they can make it transitory, but they're going to have to raise rates.
Big time.
Yeah.
Yeah.
And the only way to bring the inflationary beast to heel is to raise rates.
That's right.
So I'm looking at the market action this past week, which we saw big sell-offs in the S&P 500, the Dow Jones, the NASDAQ.
Yeah.
First, weakest it's looked all year, since March anyways.
The last couple of months has been just a distribution pattern on the NASDAQ and the TSX Venture. It's range bound, but it looks like it's starting to roll over, which, last time I checked, I got a favorite stock, U.S. Copper. It's in the TSX Venture.
Yeah.
It just seems to me that maybe this inflation will be transitory for a while because of what we're seeing, right?
Yeah.
Like, come on, look at copper. Lumber was, as we know, it spiked to 1,700. Now it's.
Well, here's the chart on lumber.
Look at that.
Let's pull out a bit because there's the tail. Like this is not inflation. This is speculation run wild. So lumber supplies got a little tight, but not enough to justify essentially what is tripling of the commodity price of lumber. This is the price per thousand board feet here.
Yeah.
This is where it peaked back on May 7th at over $1,700 per thousand board feet. And here we are a mere 3 months later, and it's back to 481.90, which is where it was at the beginning of 2021 before the beast took off. And back in late 2020, 452, but as soon as you get pre-COVID, we're back below 400 down here.
Yeah.
So, this is what I'm looking at. I'm thinking if there's a general expectation for interest rates to increase, that basically suggests there's going to be a downdraft in economic activity, and copper is reflecting that.
Yeah.
So if
lumber's already reflected it. Oil today I think was under $63.
Yeah.
And it in a month and a half ago was 76.
Yeah. Well, let's pull up the oil chart here. 68, 66, 67 right now.
That's West Texas oil. 63. What does that say?
63.40. 63.40.
Yeah, that's the number.
Yeah. And the 10-year down to 1.23. So we're still not seeing anything there.
No, but I'll tell you, there's shakiness out there. There's people, I'm watching stocks that, in our universe, this speculative, they're just sliding.
Yeah. Well, let's take a look at all the major indices here. Okay, so there's the S&P is up 12 points, but that's after a multi-day sell-off here. Let's zoom in on that. Dow Jones Industrial Average down 46 points. NASDAQ up 118. Okay, so it's basically recovering some ground here, but I mean, this is the thing.
You see, you look at this. Now, there was the big run, and then we've had attempts, but we can't get going. We're going sideways ever since, they're talking about inflation. Inflation's not good for the stock market.
Oh, there's my sideways arrow for you.
There you go.
Whoa, look at that. Exciting. But this is, there's a trend intact here. That is, decidedly downward.
Yeah.
So like, that's what I'm focused on. Is this a general reversal in trend, or is this a short-term correction?
Well, I think, you know, who else is probably looking at the screen right now is Chairman Powell. He's probably trying to figure out the same thing.
Yeah.
And I think everybody is trying to figure out, and I think, you know, maybe the Fed will make it look transitory to say we were right.
Well, that's just it. The ball is in the, I mean, this is the continuously flabbergasting thing to me is people talk about interest rates and inflation as if it's like some mysterious force of the universe that we are trying to understand and trying to influence. And it's like these are under the direct control of a small group of old farts who claim to be independent from the government, yet do not make a single move without clearing it with the government first. Remember when Trump started freaking out on Jerome Powell because he was talking about, you know, maybe having an interest rate hike and maybe slowing down on quantitative easing, and Trump jumped all over him, and that's it. He reversed course on that and said, nope, we're going to pick up the pace. And they started, you know, quantitative easing through the Fed, the overnight repo market. So, you know, for the news to portray the movement of interest rates and inflation rates as some kind of natural phenomenon is the height of disingenuousness at the very least, and probably more representative of large-scale fraud on the part of the financial mandarins of the financial system.
You know.
So that's just it. Where is this going? That's what we're here to figure out.
Well,
we're
going to figure it out over time. We're not going to figure it out today.
Yeah.
Because you just don't know what's going to happen next week. But, you know, when you look at some of the international events like Afghanistan, you look at in China. Now,
well, there's a good case in point. Afghanistan. Do we add Afghanistan at this point to the list of destroyed countries as a result of failed U.S. foreign policy and their lack of commitment to their allies in NATO? I mean, the Russian foreign minister rightly pointed out, I don't know if it was the foreign minister, somebody senior in the Russian government publicly questioned America's commitment to the Ukraine based on what happened in Afghanistan.
Yeah, there you go.
Well, and fair comment, would you not say? And so, you know, we live in this age where the mainstream media, any comment that is critical of U.S. foreign policy or U.S. monetary policy disappears and gets no views. And, you know, meanwhile, the vapid talking heads on CNBC, you know, draw all these correlations in the market that are, yeah, they're accurate correlations, but they're fundamentally driven by bigger factors that they never talk about. So this is the thing. You know, you look at a market like this in August, everything's drifting lower. You know, commodities are drifting lower. It's a buy nothing environment. If you ask me.
That's exactly how I feel. And the other thing you got to remember is that if you ask people that know what's the worst month for the stock market usually, on average,
August,
September.
September,
I think is one of the worst ones. October is one of the worst ones, and August is one of the worst ones.
Oh, okay. So the third quarter is basically.
Where are we heading into?
Yeah,
September.
Well,
and then with more people coming back, it may exacerbate the trend. Yeah. I'm not gonna make any crazy predictions because we saw just when I was pretty sure that Bitcoin was going back down, it went from 30,000 to 45,000.
Yeah.
You know, so they can do magic things.
We'll talk some more about Bitcoin when we come back, but right now we're going to take a look at a next generation graphene aluminum ion battery that has no cobalt, has no nickel, and certainly no lithium. My guest now is Craig Nicol. He's the founder and CEO of Graphene Manufacturing Group, trades on the TSX Venture under the symbol GMG and trades in the United States under the symbol GMGMF. Craig, welcome.
Hi, James. Good to be back on.
You bet. It's great to see you again. Craig, you just announced a $10 million private placement, and that comes on the heels of your announcement that you're investing in your own pilot plant. Is the $10 million raise to basically cover the initial cost of that plant?
Yeah, great question. We're excited about the announcement on the raise, the $10 million raise. The pilot plant is actually a small amount of money. It's not that much, so that'll be taken care of with existing funds. The $10 million raise, we believe, will go largely towards building the larger production plant, which we hope later this year or early next year we'll take into an investment decision, which means that we're really, following a complete successful raise of this $10 million round. We're really set up for success here, which we're very, very happy about.
Yeah, no doubt. So Craig, when I first met you a couple of years ago, you had so many different sort of opportunities in the graphene space: coatings for air conditioning units, fuel additives, and you name it. I remember being so excited about the company because there was just so many angles to the entire value proposition. Are all of those different projects still at some point of evolution?
Yeah, so we've probably went through about 200 different types of products that was tested in 20 different countries. And we're really only focusing on 3 now. And one is our air conditioning coating system, and that is mainly in Middle East, Malaysia, Southeast Asia, and Australia. And we're progressing, hopefully, into some type of near-term significant sales there. The second topic or product that we're focused on is the graphene lubricant concentrate, and that's where we're showing some really good results in showing reduction of friction in some base oils and engine oils for different companies around the world. We're talking some very big names there. And the third one is obviously our aluminium-ion batteries. So we've got, from time to time, we still get amazing different opportunities proposed to us. But we're very focused on those 3 and near-term material sales out of those. And the batteries is the least developed, but it's actually the most exciting, the most we get talked about, which is great, because it's good to have that product which really has an almost unlimited market opportunity, and it's still some way to go to get to where we need to be, but it's also very, very exciting. So it's good to have the first 2 focused on revenue, and then the third one, well, that's kind of like the blue sky opportunity.
Yeah. The battery is obviously attractive because you announced that it was, what was the energy density coefficient to current lithium ion?
Yeah, it's somewhere similar to or around or just below. It's about 150 to 160 watt hours per kilogram. So your lithium ion's about 250 watt hours per kilogram to 300 watt hours per kilogram. But we likely won't have cooling. And so when you actually put the cooling weight into that energy density for lithium-ion batteries, it brings it down to about 140 to 150 kilowatt hours per kilogram. So the net outcome will be around the same at the stance. What the little detail that often people miss is that that's at our charging energy density is at a very high charging rate, something close to, easily 10 times more that you would normally see for another battery. And when you charge the batteries faster, they actually store less. So we've got to do a lot more work to show what happens when they have the normal charging rate energy density. And therefore, it will be, belief will be much higher than even where lithium ion sits, even when you take the cooling out. So there's really a long way we can go with this. That's only initial testing data. So we're at or around where lithium ion batteries are right now. But we think in the future, as we take more material out and get them optimized, we'll continue to drive that energy density up. The theoretical maximum is 1,000 with these batteries. So it's about 1,050. So the chance to really make a earth-shattering energy density battery, is there.
Right. And then the other thing that's attractive to me that is not so much talked about is the idea that it's composed of graphene and lithium graphene and aluminum, as opposed to lithium and copper, or lithium and cobalt and nickel.
Yes.
Are nickel and cobalt components in your battery at all?
No, and we don't even have copper either. So it is a really simple battery made of two main components, an aluminium foil. And so a graphene is our main contributor, and it's about 3/4 of the battery weight. And the rest of the battery weight is aluminium chloride and aluminium foil. And they're relatively low cost and abundantly available and recyclable, which is fantastic for the earth and for our business. So there's real opportunity to make something that has really long-lasting energy performance, energy density. We have also probably one of the highest power densities. Now, that's not often talked about. So energy density is generally how far you can drive in a car, but power density is how fast you can accelerate. And our power density is extreme. It's something like 70 to 80 times more than the normal normal lithium-ion batteries. And so what that means is it can be charged much, much faster, and also can be discharged much, much faster. And that's going to be really helpful with electric aviation. Electric aviation really has got some issues with existing batteries, and our battery will be able to fill that need. And that's very useful for, say, electric planes, but also air taxis, which, believe you me, in the next 10 years, we probably will see those around more and more. And also large drones, and also large trucks. So rigs will need very high power density batteries, more so than current batteries out there, and our batteries will provide that. So we've got a number of really large existing opportunities in personal electronics, because the faster you charge your phone, the faster people want to buy one, right? That's the first thing. But then you've got all these new markets that are coming on that we believe our battery is going to be quite a high performer for. And then the third area, I think, which is really fascinating is IoT. So Internet of Things are going to need lots and lots of small batteries to power all these sensors, millions and millions of them. And our battery is perfect for that, because currently it's sitting at about 10 years lifespan with no issue. It could well go for another 10 or 20 years. We'll see. We've just got to do all the testing. And it's very high fast charging and very high fast discharging, which is also very good for IoT that can take a sudden hit and get recharged and move on. So there's three really large market sectors that our battery can go to. But we're just going through. We're using our pilot plant, making some batteries for that out of the pilot plant. That should be finished and up and running in the next couple of months. We're still working with University of Queensland. They're obviously making our batteries as well. And so we'll start issuing those coin cell samples by the end of the year, and then let's see where we get to with our potential customers and the next stage production plant.
You bet. I would think that given the incredible cost savings, the improvement in energy density, the improvement in power density, that this would be of extreme concern to the likes of Elon Musk and Tim Cook. Like, has Apple or Tesla or any of the major appliance manufacturers come to you and said, look, we want to get a piece of this now?
Yeah, well, we've had many different types of companies, over 100, and honestly, it's probably nearing 200 now, companies around the world. We've probably had another 10 this morning who've just asked for partnership opportunities. We believe will continue to happen. I've never actually been in a marketing role. I've been marketing energy products for about 25, 30 years. I've never been in a marketing role where the phone just doesn't stop ringing and there's just no way to supply or answer even all the questions that you get, because your phone just doesn't stop being called by prospective customers. You can imagine that the types of companies that are talking to us. Yeah. Obviously, we've got to complete on our battery next stage testing program, which is looking quite good. Brisbane is now out of lockdown, so that is really helpful to get our coin cells made. We were in lockdown for the previous 2 weeks. That will enable us to get back out there and get the coin cells made, get the testing data, show that we understand our battery, which is really what these big companies want to see. They want to know that we understand our nanochemistry for these batteries. And we believe we do, but we've got to go through all of those steps. The big guys will take longer. That's always going to be the case. And that's okay, because we've got the team to deliver what we need to get them what they need. And we just got to go through the steps. But now, with this announced $10 million raise on the back of a already well-funded bank account from the previous raise, we feel like we're pretty much set up for success, which is really, really exciting.
Yes, it is. Yes, it is. All right. Finally, Craig, I'm just curious as to the level of protection that you might have in the IP department, because, when you put out a press release saying that we are developing this graphene aluminum ion battery with the University of Queensland, I would think there would be a lot of people saying, hey, let's put our research department here to try to figure out how they're doing this. So is it patented technology at this point, or patent pending, or what's the status of that?
Yeah, so University of Queensland had developed the technology and patented it. We are, under the license agreement, we are the funder of those patent rights. So we, in combination with University of Queensland and their IP commercialization arm called UniQuest, we meet to discuss on how we will what's called prosecute the patent, which is to deliver through to final patented outcomes in different countries. We feel pretty confident. University of Queensland has obviously got a long list of amazing nanomaterial and bioengineering patents that are long living in the world already. Including the cure for cervix cancer, which is quite an amazing accomplishment that was actually patented or delivered and patented in the university institute that we're getting our technology from. But we'll continue to watch that space. We're not anti-lithium-ion battery. We're just for aluminium-ion battery. So we've just got to keep pushing our space, and I think it'll be clear that our battery will perform at a point that really no other battery will be able to kind of compete. So it'll need, in a way, new batteries to emerge to be able to compete with ours. Yeah. And so we're not really against the existing establishment. We're often maybe best against the new type of batteries that are yet to be announced or have been announced but haven't been maybe made as public as some others. So because there really is needing a step change in batteries needed in the world. We need a battery which is more environmentally friendly, it lasts longer. We need a battery that is more easy to charge and is recyclable. Yeah. And has a minimal footprint on this world. And that's what we believe we've got. And I think there'll be others that'll come up. And that's okay, because the market is massive and there are so many applications that we need as many awesome batteries as we can to make this happen.
All right, Craig, we're going to leave it there for now. I really appreciate your time. Thank you so much for the update, and we'll come back to you soon.
Great. Thanks, James. Talk soon.
All right. Bye for now.
Still one of the best performers out there, I think.
Yeah, well, so they just announced a $10 million overnight marketed offering. I haven't seen the press release that it's closed, but the price, I think, was $2.05 a share. It's a short form prospectus offering, so no hold period. And
no warrants.
Well, there's a half warrant.
Half a warrant.
Half warrant at, I believe it was $3. I could be wrong there. Don't quote me on that. But yeah, but exhibiting exactly the same trend as the NASDAQ in that, selling off and going a little bit quiet as we get into the depths of the dog days here of summer. So, let's talk about crypto again, because there's been some really interesting developments. The Binance, which is the company that's running one of the world's largest crypto exchanges and has a lot of dealings with Tether, the Dutch Financial Authority just announced that they were not in compliance with Dutch financial regulations and were therefore no longer permitted to conduct business in the financial community. Tether.
It's amazing that since we've had some pretty intelligent people say there's something going on there, nothing's happened. And yet New York's already fined them. I don't know. It just seems...
Yeah.
Maybe there's so much going on, there's not enough watchdogs.
They did...
I don't want more watchdogs, to be honest with you. But
well, I mean, it gets to the point where if you don't have a watchdog, let's go crypto here. Bitcoin USD, let's take a look at that for this conversation. So yeah, that's, what an incredible move, eh? After getting down here to $29,000 back in July, it looked like it was over. And then boom, Gary Gensler comes out and says, the United States needs to regulate these cryptocurrencies in preparation for this new universe, and he starts promoting cryptocurrencies generally. And the whole crypto community goes nuts, as exemplified by Bitcoin's price action, not realizing that Gary's not talking about crypto coins like Bitcoin or Ethereum or Ripple or any of those. He's talking about the US dollar digital bank cryptocurrency. And this is where I think, this is just another run-up. This is another batch of people who are just going to get completely destroyed, though people are paper billionaires now. But I still say that it's a house of cards, and it's coming down within the next 2 years, I actually will say now, because it's pretty clear to me that they're going to try to clean up the debt situation because they're reaching a hyperinflationary point in the money printing, which can't be sustained because that's what's driving the demand for dollars lower. And in a world awash in dollars, what's happening? Nobody wants them. So anyways, I think that this is, as we like to say, the chickens are coming home to roost. But some interesting alternatives to the investments we normally talk about. Our next guest is involved in a superfoods movement, and we'll let him tell you about that. My next guest is David Kerbel. He's the CEO of Rritual Superfoods, trades on the CSE under the symbol RSF. David, welcome.
Thank you very much.
David, can you give me an overview of what the business of your company, Rritual Superfoods, is?
Sure. Rritual Superfoods is the first award-winning premium functional mushroom and adaptogen in the superfoods marketplace. But we're more than just a mushroom company. Really, it's a superfoods platform that we play in.
Okay. So there's been a lot of mushrooms in the news lately, and this is not in the field of psychedelic mushrooms for mental wellness, is it?
No, it's not at all. These are functional mushrooms and adaptogens, plant-based, all natural, vegan. But the interesting part is one of the side benefits is certainly mental fitness. Our reishi and adaptogenic ashwagandha root tie in together to really help for stress relief. We also have our lion's mane, which we tie in with rhodiola to really give us focus, and chaga, which helps boost our immune system that really, again, keeps us right and feeling good, both mentally and physically. But it's nothing to do whatsoever with psychedelics. No.
Oh, okay. All right. So these are the other wellness categories of functional mushrooms. That's interesting to me.
Right.
I have lion's mane that fruits on my property in maple logs every winter, and so we eat those religiously. And then I have also chaga, which during the pandemic, when it first came on, we were pulling out all the natural stops we could. So I've got great experience with those, and certainly I've not had any virus so far. So what is the market for this? Is this a wellness market for bioceutically minded customers, or are these more geared towards a general nutritional market?
It really, it's a great point. So we are proud of the fact that we're plant-based products. We're vegan, we're natural, we're organic. But at the same time, the marketplace in North America has really shifted. It's not just going into a specialty shop, although we have distribution there. It's really the mainstream brick and mortar retailers that are getting behind this and really seeing the opportunity and taking advantage, giving their consumers the products that they desire. So our biggest retailers in the country, in the US here, are Rite Aid, which is in CVS, two of the largest drugstore chains in the world. And we also have very good distribution in the natural and organic space. So it's more of a mainstream item, although, again, our roots that we're very proud of we're plant-based, organic, and natural.
Mm-hmm. So then your source of lion's mane mushroom is wildly cultivated or not cultivated, wildly grown in the woods?
Well, no, it's done. And it's a great question. So we take the mycelium, which is the root system. That's really what we use. We powder it, but we take it off of organic mushroom farms throughout the U.S. They have to meet an organic standard for us. They have to be all natural. And again, we take the mycelium, dry that out, form into a powder, tie it in and mix it with adaptogens and cacao and really good tasting products so that we can have a good mixability, a good shelf life on our product, and it's efficacious.
So you're cultivating mycelium and using the dried mycelium. You don't actually fruit the mushrooms to get to the end product. There's no difference between the mycelium and a fruited body derived from the mycelium, is there?
No, not really. But the mycelium is really that infrastructure underground, that stuff that really is full of nutrients and powerful. Our product has to be efficacious. So that's really our secret ingredient there is we take the mycelium, we dry it out, we tie it in with adaptogen and really make an efficacious and good tasting product.
Oh, interesting. Okay. And so then the chaga, where do you derive that from?
The same thing. Again, all natural and organic farms throughout the U.S. We derive all of our chaga, our lion's mane, and our reishi from U.S. certified organic mushroom farms.
You can propagate mushrooms, reishi mushrooms, chaga fungus, and lion's mane entirely from the just mycelium.
Right, correct.
Interesting. So then why is there this sudden interest in all of these functional mushrooms? Why is it happening now and not previously?
Yeah, it's a great question. I mean, functional mushrooms have been around and used for relief in inflammation, in wellness for thousands of years. It's just, I really believe that we've come to the party. There really aren't a lot of premium players. We've branded this well. We've come up with an efficacious formula. And really, again, it's the right timing. We didn't certainly plan this around what's happened in the catastrophes of the world. We planned our company at probably about 4 months ahead of time. We've been fortunate that we are serving the needs of our consumers and our retailers by offering this product. But it's really the right time and the right place. Folks are really looking at natural, plant-based alternatives to everyday stressors.
Mm-hmm. Okay, and so then what is the total addressable market worldwide for these products?
Yeah, so in the functional mushroom space, the global footprint is trending toward $55 billion with a B and USD, and that'll be by the end of 2025. So it's around 35 and growing right now and trending on a bigger basis. The superfoods market is a $300 billion marketplace. So it's important that we distinguish where our first products are mushroom based with adaptogens. That won't be our last product. We're always going to be true to our company, good for you, organic, healthy products, but it'll be in different formulations and formats that may or may not just feature functional mushrooms and adaptogens.
Mm-hmm. Interesting. So what about competitive landscape? Are there a lot of companies in the space, and are there big food conglomerates contemplating this?
Well, I think our largest competitor is publicly traded right now on NASDAQ, Laird Superfoods, and they certainly bring a lot to the marketplace. They've been around for 9 years. What's really important to us is in a very short period of time, we committed about a year ago, before we even went public, we committed about a year ago to being in 2,400 stores, brick and mortar stores, throughout this first year. So in our first calendar year, we listed in March, we committed to our retailers, we committed to our investors and our shareholders that we'd be in 2,400 stores. What's really cool is we're well over 3,000 already and continuing to grow. Why I bring that up in context with Laird's, their business has been around for 9 years. And by the end of this year, we'll probably be in as many retailers as they are. Mm-hmm. So we feel real good about what we've done.
Wow. So then what's the growth profile of the company revenue-wise currently and going out 12, 18, 36 months?
Yeah, we'll in our first 12 months of shipments, we'll be in our first base of product. There's two important distinctions there. Our first 7 items that are in distribution today are only our first tranche. We've got 2 more ready to ship in Q4, and then we've got 17 more for 2022. So I want to put that in context first. But our first 12 months of shipment on our base products alone, just in North America, will be around 8.4 to 8.5 million in USD sales. Our second year, we're looking to at least double that. And again, that's just with our baseline. With our new items that are coming out and our next launch of products will be well over 16. And then 2023, we're around 25 million. But again, the upside on that is probably 2x once we launch our full bevy of products.
Sure. And so I see that you're delivering to the Amazon Fulfillment Center. Do you have a online store on Amazon?
Yeah, it is live already. So yes, we have a company store, US customers on Amazon, as well as RiteAid.com and our own website, Rritual.com with 2 R's. And we're selling quite a bit. We're very pleased with that distribution.
Yeah, I bet. Well, so my question for that was, if you were to see sort of viral explosion of interest on the Amazon scale, do you have the current production to meet a, for example, 10x sudden demand jump in your products?
Sure. And that's going back to the importance of the mycelium and drying that out. So if we were just on the fresh market, we have cycles in terms of which the product is cultivated. And then, we have that growth cycle to worry about that lag. So the answer is yes. I feel very good because our product can be derived at one time and run at 2 or 3 different components, which is terrific. And then it stores well. We have a 2-year shelf life on our product. So the answer is, if we were just dealing in a fresh market for raw material and ingredients, I wouldn't feel as good. But with the team that we've got, with over 150 years experience in our team in the consumer packaged goods business, feel very comfortable with a trajectory of 3, 4, 5, 10x growth. I really do.
Wow, that's incredible. Well, David, this is a company in a sector that is really near and dear to my heart. I'm a big believer in naturopathic approaches to brain health, body health, etc. So we're going to follow this story. I really thank you for your time today, and we're going to come back to you in a couple of months and see how things are rolling out. Thank you very much for your time today.
My pleasure. I look forward to it.
You bet.
So look, there's the beginning, popped up, and then bottom, and then we're right there. We're right just below it. This looks like it, I hate to say it, it doesn't look good. It doesn't look good. I think the company's doing great things, but
no, this is my point, is this is more so a reflection of the corporate structure than it is the fundamental drivers of the company.
They did an announcement of a month ago, or I can't remember the date, but they came out and said their sales for the last week of March were $900,000. That's 1 week of revenue just launching a new product. Haven't heard another number yet, and they have to report by the end of this month. So the August, the quarter ending May or June is going to be reported this week, and I'll be very curious to see, because they're in, as you would know from your interview, they're everywhere. they've done some right things, I think.
Yeah. No, he's. It's an incredible story because we have lion's mane mushroom growing on our property, and we actually harvested it live and ate it in we had it in a lobster bisque. We had it with steak, and we had like 3 blooms of these lion's mane mushrooms. It didn't make me any smarter, but they were
funny
very
because
tasty.
I was thinking you're pretty sharp today.
Well, it's
you seem sharper than usual.
That's a miracle. I even forgot to do my CBD this morning. Yeah.
I think you got to eat a lot of different, like my doctor, he said, eat as many different types of foods as possible. Don't get stuck on one thing, because then your body will start to specialize. And when it specializes, you take away that thing, it can't adapt.
Well, this is the thing. So habitually, I eat a bowl of fresh cut organic fruit every single morning.
I think that's one of the smartest things you can do.
Well, but am I creating a predisposition towards fructose?
No, because it's real food. Like right. I would say, stay away from eating foods.
Cheeseburgers.
The bread more probably than the cheeseburger if the cheeseburger's got good ingredients.
Yeah.
But it's like if you take flour and you mix it up and let it harden, it's like cement.
Yeah.
So you keep eating that. What do you think that's doing to your arteries? Like,
yeah.
Fresh fruit, nuts.
Yeah.
Nuts. I'm nuts.
Nuts about nuts. Yeah.
But I think there's a thing inside mushrooms. They're saying mushrooms are becoming in the top 10 of superfoods.
Well, it's interesting because in this farming environment, a healthy mycological network in your soil is synonymous with better performing crops. So it's like mushrooms it's interesting that mushrooms are like a major link in all ecosystems, be they human organisms or plant organisms, that without them present, you don't get the full potential.
Isn't that interesting?
Yeah. Anyways, next up, my good friend Wolf Richter joins us from San Francisco. Next up, Wolf Richter, publisher of WolfStreet.com. Wolf, welcome back.
Thanks for having me back.
Yeah, it's always a pleasure, Wolf. Your recent commentary earlier this week was basically suggesting that, that rightfully so, that inflation had now reached 6%. And you made the case that you compared it to the period of the late 70s to early 80s where inflation, or rather interest rates, jumped to 20% as a result of bond vigilantism in part, but also because the Fed failed to act to stem the inflation that had been caused by prolonged lower interest rates. So I guess what you're saying in this is that get ready for 1980 part 2?
Well, I don't think we're going to see 20% interest rates. I don't think that would be feasible for many reasons. But even if we see long-term interest rates, or say mortgage rates of 5 or 6%, that would be a big enough a shock for the economy, for the housing market, for corporate borrowing, for all kinds of things, to sort of clear out the cobwebs a little bit. And so the environment has changed. Now, if we had many years of high inflation, we could eventually get back to high interest rates like that. But in the 70s, that inflation lasted for a long time. It went up to 12% over the years, and then it went back down to 5%. And people thought it would go away on its own, and the Fed really didn't do anything. And then we got a second oil shock, and it just kept rising then. And so inflation eventually hit 15, 16%. And that's when the Fed really started cracking down, by which time inflation had been a problem for a decade. And so we're not there yet. We just started in this process. So, but the Fed back then had been dragging its feet forever to do anything about it, until there was finally a political consensus between the Fed and at that time the Reagan administration to do something. And so without that political consensus, a central bank can't really crack down you can't really tighten policy very much and cause a tailspin in the economy and in asset prices if you don't have the backing of the White House. And Volcker got that with Reagan, and so he cracked down with both feet, and it stopped it. Now, the thing is, by that time, the bondholders, the big mutual funds and pension funds, they have gotten crushed in the decade leading up to it. So they had received yields that were far below the rate of inflation. As rates went up, bond prices went down. So they got hit from both sides, from the decline in the value of the bonds and from below interest rate inflation. So they really soured on bonds. And that's when the bond vigilantes were born. So when the 1980s came around and inflation rates dropped, bondholders said, nah, we don't believe this. Now we're not going to buy these bonds at low yields. We're going to demand higher yields. And so for the next 20 years, next 15 years, they were able to get yields that were far above the rate of inflation. Now that has ended, but that's the bond vigilantes that lived for 15 years until essentially 2005, and then of course in 2008 the Fed started buying bonds, and in that process it took the bond vigilantes out the back and shot them, and there haven't been any since then.
Right. So that's basically how Fed policy has evolved then. And I guess kind of like one of the secret or unexpected benefits of rampant quantitative easing is that with the Fed being the biggest buyer of its treasury debt, that there is no bond vigilanteism possible, because now if you want to be a tier 1 bank, you have to participate in the Fed auctions. Otherwise, they don't take you out back and shoot you. They just shoot you right in broad daylight. So we've got this situation where people don't understand that the Fed actually, while on paper is a independent of government organization, in actuality, they are the respiration to the Treasury's aspiration. I mean, they can't function without each other. And so, the artificial low interest rates that have now, I have got to think that besides the runaway inflation that we're starting to see as a result of low interest rates creating all kinds of artificial demand in corners of the marketplace that we don't normally see it, that they've now painted themselves into a corner. For even a 1% or a 100 basis point rise in interest rates is going to cause serious friction within the whole global debt system, because everybody has become so tuned in to this low interest rate that their financial house of cards is sort of built around that now. So this is why your commentary was interesting, because it sounded to me like you were basically warning that this is only going to get fixed with higher interest rates. Yet I don't see how that's possible. So, I mean, what are the options that the Fed does have?
Yeah, so I think a 20% rate is not an option. Let me just put that right out there. Those times are kind of gone, at least in the foreseeable future. But the Fed ended tapering in the last cycle, and then started raising rates, and then started quote unquote normalizing its balance sheet, so reducing its balance sheet while raising rates. And President Trump at that time started really hammering on Powell to stop that, and so I mean, he just on Twitter, in public, and that's just never been done before, and Powell caved and he stopped, and he did a 180, and now the thing is that Biden is already getting nervous about the high inflation. Consumers hate it. Consumer confidence has plunged because of this inflation increase that we're now seeing. It impacts everything consumers are buying, from cars to gasoline to food to rents. I mean, this is a long list. It's not an oil shock. There's not just one little thing that's going up. It's everything, or a lot of things. And so and house prices. So there are a lot of really frustrated people out there, and it's shown up in consumer confidence readings just now, and so the Biden administration is getting really nervous, and I think they're going to do the opposite of Trump did. They're going to have some kind of understanding with the Fed that it's okay to raise interest rates. And Yellen has already said that a couple of months ago. She said higher interest rates would actually be good for society overall and for the Fed, for various reasons. And so I think they're laying the groundwork for higher interest rates, higher long-term interest rates and higher short-term interest rates, and but not 20%. So now for the 10-year yield right now is 1.3%. I mean, it's over 4 percentage points below our rate of consumer price index inflation here, and that's just that we haven't seen that in 40 years. So. Yeah, the short-term interest rate would have to come up pretty close to the rate of inflation for the stimulative effects to fade off. They would be, depending on where inflation is going to be next year after next, now it'd be, 3-4% range maybe, and longer-term interest rates maybe in the 5 or 6% range. That would probably be enough to tamp down on inflation, especially since the Fed has its huge balance sheet. Now it can start reducing it. That would put further pressure on long-term interest rates, upward pressure on long-term interest rates. So they don't have to raise short-term interest rates that much to get long-term interest rates to come up. They can just reduce the balance sheet. And so they have an option that the Fed didn't have 40 years ago. And so I think when the Fed raises interest rates, we're looking at 3% maybe, or 4% on the short-term side, not 20% or 15% or anything like that.
Mm-hmm. Interesting. So then if I was a betting man, which I kind of am, I would say that the market seems to be anticipating higher interest rates in the evidence sell-off that's been happening over the last few sessions. And certainly the weakness in tech that constitutes, if it persists for a little bit longer, will actually be the first actual correction in the S&P or rather the NASDAQ in almost 3 years, except for last March's small tantrum. But do you think that that's one of the byproducts, is that the markets are now reflecting that expectation? And I want to top that off with the fact that copper, which raced to a commodity high price of $440, $450 or something, just recently is now backed off to $411. Lumber, which had been trading at $1,700 per thousand board feet, is now backed off to $480 per thousand board feet, which almost lends credence to the Fed's stipulation that, this inflation is transitory and will pass. Yet the action in the market suggests that there's an expectation for higher rates, and thus, we're seeing liquidity drying up in the stock markets. Is that all part and parcel of this expectation?
Yeah, so what's going on in lumber is somewhat unique, and the spike in lumber prices that came out of nowhere, because there was never any shortage of timber, and timber prices didn't go up. So it was just lumber, so plywood that shot up very quickly to very high levels and then came back down, and that was a speculative kind of driven thing, and that happens with commodities, specialized commodities like lumber. We've had in the energy sector, we've had price increases that are substantial, including natural gas and crude oil and other things, and then the other commodities. Now, their commodities go up and down, but lumber never went into inflation. It's not part of our inflation basket. Neither new houses nor sheets of plywood are in the inflation basket, so it never was part of the uptick in inflation, and it's not in the down. It wouldn't be responsible for any decline in inflation. Now, what caused inflation in the United States is a shortage in certain types of consumer products. So particularly used vehicles and new vehicles, and then there's some other factors that come into it. Now these prices just went crazy, but that shortage continues. So there's still not enough supply to do to vehicle prices what had been done to lumber. And now other prices are going up. We've got service prices going up. Services are 70% of the economy, so those prices are now starting to get pushed up. The housing costs are not reflected properly in CPI. So housing costs have been skyrocketing, but they're not the way the CPI is set up. There is a third of CPI is a housing component, but it's not based on house prices. It's based on what homeowners think their home would rent for. So it's just an imaginary number, and it's been under 2%, even though the house prices have increased by over 20%. So and that's a third of the inflation basket. So there are all these underlying pressures that we have, and consumers feel them and see them, and they're transferring now from one product category to another. That's how you get that spiral. One thing might come back down, then there's another thing that goes back up. It goes up, and that's what we're seeing. It's like this game of whack-a-mole that the one thing went up and it's going back down, and then we got another thing that goes up over here and it's bigger, and so we, like in the 1970s, we will see a decline in inflation at some point, and everybody will say, that's great, it's going away on its own, and then suddenly it'll turn around. I mean, that's how inflation operates. And you have, by looking at the year-over-year number of inflation, so the consumer price index today compared to how it was a year ago, you have the base effect from a year ago, so that changes the percentage. So next July, we have this big inflation number today's big inflation number as a base. And so next July, our inflation reading is going to be lower. That's just baked into it. And because we have this huge base from this year, and then it's going to go up again. I mean, that's just I can predict that. It's pretty easy. And just because how the annual numbers work. And so I don't think that there are any economic dynamics at place at this point that will lower inflation. I just don't see that. We have a huge amount of stimulus. We've got government deficit spending out the wazoo. We've got the Fed still printing money. We've got zero interest rates on the short term. We've got long-term interest rates that are 4 percentage points below the rate of inflation. I mean, all this is hugely stimulative. Consumers are flush with money that was given to them, not from work, but that was given to them. And there's just the stimulus just won't back off for a while. That'll be there. And so we have demand, we have hot demand, and we've got some supply problems. So I don't see I don't see anything in that scenario where inflation will go down. I just don't see that.
Yeah. Well, and so this is what I thought you might have been sort of alluding to in your cautionary tone talking about inflation is that, historically, the end of a currency occurs when the hyperinflationary phase sets in. That is always the end result of debasement, quantitative easing, or money printing, or whatever you want to call it. I mean, the bottom line is too much money. You start to see the price of money go down in the form of interest rates. Then you see and coincidentally, you see the explosion in prices across the board as money chases, all this hot money chases, a finite pool of commodities. So is this then, I look at this and I think, geez, this looks like that we've entered the hyperinflationary endgame for the US dollar. And that's just something that people look at me and think that I must be from outer space if I think the US dollar is going anywhere. Yet, we have all kinds of evidence. We have this support for digital bank issued cryptocurrencies starting. We have all these indicators that, it looks to me like even the Fed has sort of written the dollar off and is now just using this last hyperinflationary gasp to capitalize some of its pet sort of membership or something. I don't know. But do you see a hyperinflationary endgame to the US dollar as a result of this at all?
Yeah, no, I don't see that. The reason why I don't is because the Fed and its constituents don't benefit from that. Nobody benefits from that. And that would be a very harsh thing for an economy and asset holders to go through, and for banks to go through. We have 12 regional Federal Reserve banks that are part of the Federal Reserve System. Those 12 regional banks, like the New York Fed and the San Francisco Fed, they're privately owned. They're owned by the banks in the districts. And it's only Powell's entity, the Federal Reserve Board of Governors, that's a federal entity. So, nobody so these are the constituents of the Fed, the banks, nobody benefits from hyperinflation. So the Fed is uniquely positioned now because it has $8 trillion on its balance sheet. It is uniquely positioned to crack down on inflation. if push came to shove, it could sell outright those bonds that it has, and it would cause all kinds of mayhem in the markets and bring asset prices crashing down, and it would cause deflation so bad you wouldn't believe it, and it would unwind any thoughts of hyperinflation in the New York Minute if it did that. It obviously is not going to do that, but it could do that, and if there's any chance that hyperinflation is approaching, so hyperinflation is 50% or so a month. We're at 5% a year, so we've got a long ways to go. But if we get to a point where this is starting to go really out of control, that the Fed does have the tools to crack down on it, and it will cost that cracking down. Will be very painful for people who hold assets, because it will bring down asset prices, because it will increase the value of the dollar. I mean, that's what it will do, and it will end it. It will end any deflationary pressures. It will just wring it out of the system with one of the worst recessions we have ever seen. And the Fed could do that in theory. So I don't think I don't see hyperinflation out there. I think that can be prevented. I do see the kind of inflation we have, 3% to 8%, that range, maybe low double digits. And Fed's already getting a little nervous. The White House is getting nervous, about the inflation we do have. So I don't think, maybe I'm naive, but I just don't think hyperinflation is the likely outcome here. I think it's just normal inflation that eats your lunch. I think that's what we get.
Great talking to you, Wolf. I'll come back to you as soon as I can get you on again. And
okay, great. Thanks, good.
We'll talk to you soon. So there's an indicator that inflation has, in fact, risen rather steeply. 23% in this since October of last year for industrial commodities.
There you go.
As measured by the Japanese Industrial Commodity Index.
And now you're getting a little bit of hesitation here.
Yeah.
Last, what are those, weeks or months? Months?
Yeah.
No, those last 2 months. And so,
But it would make sense for the prices to back off if we're going into a period of economic sort of quietude. And so I think that was Wolf's point, is that this is not transitory, this is...
But this is the first salvo, and then retrenchment, test, back and forth, and then we'll muddle along, and then all of a sudden it'll start over again. It'll start creeping back in, because that's what I think.
Yeah.
So that's where I'm bet. That's how I'm looking at, copper.
All right, well, we'll keep watching. That's our show for this week. I hope you enjoyed it. Don't forget to write us jwest@midasletter.com.
So long.
And we'll see you next week. Thanks for watching.